A missed repayment doesn't always mean what people assume it means, but it's always a signal that something has shifted, something has changed, or been building that is no longer manageable. The question is never just that a payment was missed. The question is, what is behind it? And what happens next? And once you understand that, the way you think about debt and about yourself, if you've ever missed one, changes. There is a belief that sits underneath most conversations about missed payments, that the person who missed it simply wasn't responsible enough. That if they'd budgeted better, planned more carefully, tried a little harder, it wouldn't have happened. And sometimes, honestly, that is part of the picture. But that is far less often the full story than people assume. What is far more common is a capable person hit by something they didn't see coming, or slowly overwhelmed by pressures that built faster than their income could absorb, or dealing with administrative situation that had nothing to do with their finances at all. And understanding why missed payments actually happen and the real risks that follow matters a lot, because the reason shapes what you can do about it and how quickly. Before I proceed, welcome back to the channel. And if you're new here, my name is Novah. I've spent over 15 years in banking as a credit risk professional. And here I break down personal debt and lending through a risk lens. And if that's useful to you, consider subscribing and like each video that makes a difference to you. In this video, I want to walk through the different situations that sit behind missed repayments, starting from the most difficult and moving through to the most controllable ones. I will also share what some people commonly do to manage some of these risks, not as a recommendation from me, but as a context for how others approach similar situations. We will get to that after we have worked through the categories. There's one category I want to come back to, specifically the one that surprises people most when they hear about it. It has nothing to do with money management. Let's start with the most difficult one. The first and most difficult category is what I call the life shock. This is the event that arrives without warning and changes the financial picture completely, often overnight. Job loss is the most obvious one. Someone meeting their repayments comfortably loses their position through redundancy, a business closing, or the end of a contract. Income stops or drops sharply. The repayment that was manageable last month is now competing with rent, groceries, and everything else on a fraction of what was coming in before. But it doesn't have to be that extreme. Imagine a casual worker whose hours have been cut, a small business owner whose revenue falls in a slow quarter, a freelancer between contracts. The disruption doesn't need to be total to create a real shortfall. Then there are the unexpected expenses that arrive alongside. A medical emergency, a household or work essential that fails, a family member in sudden financial difficulty. And then there is loss. The death of a partner who was contributing to a shared repayment can change someone's financial picture entirely, arriving at the most difficult moment a person will face. Now, these situations sit at the most difficult end of the spectrum, if I may say so, because they are largely outside anyone's control. But it's also worth being honest here. Sometimes these events catch people despite genuinely good planning. But sometimes also, a buffer that might have helped was not in place. And more often than not, it's not one thing that creates the breaking point. It's multiple pressures arriving all at once. A reduced income, an unexpected expense, and a cost increase in the same month. That combination can overwhelm even a carefully managed budget. Then there's the slow squeeze. The second category is different from a shock. It doesn't arrive suddenly. It builds. For example, between 2022 and 2024, the RBA raised the cash rate 13 times. 13 times. For borrowers on variable rate mortgages, repayments rose by hundreds of dollars per month, not once, but progressively over those 2-year period. At the same time, groceries, utilities, fuel, insurance, and rent all increased. A borrower entirely comfortable at the start of that period found themselves in a very difficult financial situation by the end of it, without even changing their behavior at all. And this is the slow squeeze. No single event causes the missed payment. The cumulative weight of multiple pressures, building steadily over time, eventually exceeds what the budget can carry. The slow squeeze is particularly hard to identify early because each individual increase feels manageable. It's only when someone steps back and looks at what has shifted across 12 or 18-month period that the full picture becomes visible. And that gap between when the squeeze starts and when someone acts is where the most avoidable consequences tend to build. Now, this is the category I mentioned at the start, the one that has nothing to do with money management. A direct debit linked to an account closed when someone switched banks. A card that expired and wasn't updated. A payment set up for the wrong amount after a rate change. A system error that didn't process a transfer the borrower genuinely made. A formal letter sent to an old address that was never received. These things happen. Yes, they do happen. And when they do, the missed payment that appears on a credit file or triggers a collections contact was never a reflection of the borrower's financial situation at all. Such administrative oversight can be corrected almost immediately when identified. The borrower had the funds. The intent was there. This matters because if you've ever seen something on your credit file that didn't match your memory of events, it's worth reviewing carefully. We are now 3 categories down, 1 more to go. And then we look at what some people do to manage these risks and what to do if you are in one of these situations right now. In the interest of being complete and honest about this topic, not every missed payment sits in the categories I've just described. In some situations, the funds are available, but the payment is not being made. Engagement with the lender has stopped. The obligation is present, but not being treated as a priority. Or even other obligations have been taken subsequently and prioritized over the initial debt. Or even someone was not honest about their financial situation from the very beginning. I include this not to pass judgment, but because leaving it out would give an incomplete picture. The consequences in this situation, the impact on credit history, on future borrowing ability, and on the escalation of the account. If this is where someone finds themselves, the same practical steps apply. And the sooner engagement begins, the more room there is to work with. Earlier on, I'd mentioned that we would look at what some people commonly do to manage some of these risks. Not as recommendations, because what suits one person will not suit another person, depending on income, their stage in life, and circumstances. But I'm just sharing these as context only. Please remember, this is not personal financial advice. For life shocks, some people build a savings buffer, often discussed as covering 3 to 6 months of essential living expenses, to create a gap between an income disruption and a missed repayment. Some take out income protection, insurance, or redundancy cover. These are products designed to replace a portion of income if employment stops unexpectedly. Some at certain life stages consider life insurance on shared financial commitments, and some contact their lender at the first sign of income change before a payment is missed, because that timing often opens more options. And for the slow squeeze, some conduct regular budget reviews, quarterly rather than annually, specifically to just catch gradual drift before it becomes structural. Some people identified discretionary spending, subscriptions, dining frequency, non-essentials as the first lever to adjust before repayments come under pressure. And for administrative errors, some keep contact details, bank account information, and repayment schedules updated across all their accounts, particularly when switching banks or moving addresses. Some access their credit file periodically through a free credit bureau check, not because they expect a problem, but to catch anything that doesn't match before it compounds. None of this is a universal answer. What is consistent across all of them is timing. The earlier these are considered or acted on, the more room tends to exist. Now, if you're in one of these situations right now, here is what to do. But before the steps, there's one thing. Whatever category your situation sits in, there is one variable that narrows options faster than anything else, and that is silence. Waiting, hoping the situation resolves itself while the account continues to move. The system doesn't pause while someone decides when to engage. The cost of the delay is higher than the cost of the conversation. So the steps below are built around one principle. Early engagement matters more than which step you start with. And so the first step is just start with your own numbers before anything else. Pull up what actually went out last month versus what came in. Not the ideal budget, the real one. Sometimes there is room within the existing picture. A subscription to pause, discretionary spending to reduce, a timing adjustment that releases some pressure. Starting here may reveal a path that doesn't require a call to anyone. And if it doesn't, it puts you in a stronger position for the conversation that follows. And the second step is just that identify which category fits your situation. Is this a sudden shock, a slow build over time, an administrative issue, a decision that needs to change? The category shapes the response. A short-term income disruption calls for a different conversation than a permanent change in your circumstances. But being clear on which situation you are in helps you understand what you actually need. And the third step is that if you can't resolve it within your own budget, contact your lender. When you contact your lender, the question is, what options are available given my current situation? Depending on the lender, the loan type, and the circumstances, these might include different solutions. A temporary repayment deferral, a reduced repayment period, an interest-only arrangement, or a loan restructure. You don't need to know which option you want before you call. You need to start the conversation. And the fourth step is get everything agreed in writing. Any arrangement, any deferral, any temporary change to your repayment, ask for written confirmation. This protects you and creates a clear record for both sides. And the fifth step is that use free independent support if you need it. The National Debt Helpline provides free confidential financial counseling to all Australians. A financial counselor can help you review your budget, understand your options, and navigate conversations with lenders at no cost. As I close, I just want to say that a missed repayment is always a signal. But as we have covered today, the signal means very different things depending on where it came from. A life shock that arrived without warning, a slow squeeze that built faster than income could absorb, an administrative error that had nothing to do with financial management at all, or a priority decision that needs to change. 4 different situations, the same outcome on paper, very different paths forward. And the one variable that determines how wide your options remain is not which category you are in or how serious the situation is. It's about engagement and timing. The earlier the conversation starts with yourself, with your lender, with a financial counselor, the more room there is to work with. That pattern runs consistently across every category we have covered today. And if this gave you a clearer picture of something that matters, Share it with someone who might need it before they need it. That is how this kind of education reaches the people who actually need it most. And if you found this useful, like the video and subscribe. It helps this channel reach more people who are navigating these exact situations. Because next week, I am covering something that connects directly to what we've discussed today. See you then.